2 weeks in, the precious metals market is already behaving as if an entire cycle has been completed. The move is large. The move is visible. Both gold and silver have recorded their biggest new year gains on record. Gold has risen by $256 so far this month. Silver has advanced by nearly $17.50 across the same span. In percentage terms, gold is up 6%, already closing on last year's 7% January rally. Silver is higher by more than 24%, marking its strongest start to a calendar year since 1983. The numbers are not subtle. They shape sentiment. They alter pricing mechanics. Yet momentum will meet resistance. That resistance is already present. The pace that carried both metals upward has begun to slow. Gold finished the week below $4,600. Silver slipped back under $90 per ounce. Those two facts serve as a reminder. Price gains, even steep ones, do not erase the forces that eventually govern markets. The story behind those gains matters. It explains why the move began, why it accelerated, and why the market now pauses. For silver, the driving narrative through the second half of 2025 was a physical supply crunch. That narrative encouraged unusual behavior. Firms and institutions changed stocking patterns. Purchases accelerated. The United States, faced with policy uncertainty, began stockpiling silver for nearly a year amid tariff fears. That accumulation tightened the physical market. It amplified price moves. Late Wednesday, a decisive moment arrived. President Donald Trump announced that following a Section 232 tariff review, his administration will not impose tariffs on critical metals for now. The announcement removed a key policy overhang. It altered expectations. The immediate prospect of new tariffs receded. With those storm clouds clearing, the physical market may finally return to something resembling normal. Not completely. Not instantly. But enough to reduce the sense of urgency that had been driving purchases. Silver's pullback should not be surprising under those conditions. When the policy risk that prompted stockpiling subsides, the buying pressure tied to that risk can ease. That easement will affect liquidity and price discovery. It will not, however, erase the structural supply questions that existed before the policy episode began. Supply constraints that tighten markets remain part of the background. They have not been magically removed. They have, in many respects, simply been partially unmasked by the release of policy tension. Gold's story is different, though related. Gold has encountered what the market treats as economic reality. Recent data suggest there is no urgency for the Federal Reserve to cut interest rates. The expectation that rates will move lower this year remains intact, but the timing has shifted. The first cut likely will not arrive until at least June. That delay matters. Time, as often, proves costly. When the prospect of policy easing fades into the middle of the year, one of gold's primary near-term accelerants is muted. Higher bond yields and a firmer currency environment create headwinds. That combination reduces the velocity of speculative flows into gold. It increases the probability of short-term selling pressure and consolidation. Under these conditions, traders may pause. They may lock in gains. They may recalibrate position sizes. None of that implies an end to the metal's relevance. It does suggest a phase of adjustment. Markets do not always return to earlier patterns after dramatic moves. The old precious metals playbook is no longer the sole reference point. Traders have abandoned it. They now operate in a market defined by tighter supply, persistent demand, and shifting macro narratives. Liquidity conditions may improve as policy clarity arrives. Yet the structural constraints that supported the prior rally have not disappeared. They simply face a new context, in which policy signals and macro data both matter. The next layer of the story involves how macro forces interact with physical mechanics. With the Federal Reserve expected to hold policy steady through the first half of the year, gold faces measurable resistance from higher bond yields and a stronger United States dollar. Those elements have a direct effect on opportunity cost calculations. In traditional frameworks, higher yields and a firmer dollar reduce the immediate appeal of holding non-yielding assets. That relationship between gold and interest rates, however, has been eroding for some time. The long-standing inverse link that used to act as a near-perfect guide is no longer as reliable. Market participants have noticed this dislocation. There is little apparent appetite to reestablish the old correlation. Instead, geopolitical uncertainty continues to play a role as a consistent source of safe haven demand. That uncertainty forms a parallel support mechanism for metal prices. It does not negate the headwinds. It simply changes the profile of demand. For investors choosing sides, some analysts now suggest gold holds a slight edge. The statistics behind that view are straightforward. Silver's advance over the past 12 months has been large, 150% higher over that period. That rally has driven the gold to silver ratio to its lowest level since 2012. The compression in that ratio is meaningful. Last year, the ratio could not sustain levels above 100. Market commentary highlights that the current level may be living on borrowed time. Those phrases capture a simple point. When ratios move deeply away from historical norms, they often revert. The mechanics of reversion can be rapid, or they can be extended. Given the combination of tightened supply, persistent demand, and changing policy signals, the shape of any reversion is uncertain. Importantly, the present environment is not a simple mirror of past episodes. Historical linkages can provide perspective. They do not determine outcome. Traders now navigate a market where balance is fragile. Price behavior will be governed by the interplay of physical flows, institutional positioning, and macro signals. Short-term, selling pressure and consolidation would not be surprising. If liquidity returns to silver, price discovery will become more robust. That process would moderate volatility. Yet supply constraints have not disappeared. They remain a structural element that can reassert influence should demand accelerate once again. In practical terms, this means the market may alternate between phases of rapid advance and measured consolidation. Each phase will be driven by discrete triggers. Policy clarifications may cause one. Economic data may cause another. Geopolitical events may cause a third. The market is, in essence, being pushed and pulled by multiple, partially offsetting forces. None of those forces is absolute. None operates in isolation. The clarity offered by the recent tariff decision reduces one source of upward pressure on silver. The delay in expected Fed easing reduces another source of upward pressure on gold. Together, those clarifications change market tempo. They do not, however, eliminate the fundamental importance of the metals within broader portfolios. Both assets remain supported by elements that existed before the recent surge. Both will be sensitive to future shifts in those elements. As the adjustment unfolds, the observable facts guide understanding. Gold and silver began the year with record strength. The advance was driven by a combination of supply concerns and speculative positioning. The United States, acting on tariff uncertainty, had been accumulating silver for nearly a year. That behavior increased physical tightness. The announcement late on Wednesday by President Donald Trump that after a Section 232 tariff review, his administration will not impose tariffs on critical metals for now, removed the immediate policy overhang. The market reacted. Silver eased. Gold met resistance from macro data indicating no immediate need for the Federal Reserve to cut rates. The expectation that rates will fall this year remains, but the first cut likely will not come until at least June. These facts together create a new baseline. On this baseline, some short-term selling pressure and consolidation are plausible. A return to what many would call normal markets appears unlikely. The old playbook has been set aside. Traders now operate where supply is tight, demand is persistent, and macro narratives are shifting. Liquidity may improve, but the supply constraints that contributed to the prior rally are still present. The first half of the year, with the Fed expected to hold policy steady, presents headwinds for gold in the form of higher yields and a stronger dollar. Yet geopolitical uncertainty continues to offer support, maintaining a safe haven component to demand. Analysts who weigh these elements suggest a modest edge for gold when compared to silver, particularly after silver's 150% rise over the past 12 months has compressed the gold to silver ratio to its lowest since 2012. Observing the pattern from last year, when the ratio could not hold above 100, many market participants now view current levels as potentially transitory. This view does not constitute prediction. It simply reflects the fact set that is presently available. Facts matter. The data are public. The policy statements are documented. The inventory behavior is observable. The market will respond to these verified inputs. That response is what we are witnessing now. There is no dramatic collapse. There is no definitive reversal. What exists is a phase of recalibration. The initial burst at the start of the year delivered record gains. That phase has passed into a period where tempo matters. Silver's extraordinary surge requires a pause. Gold's steady advance must reconcile with macroeconomic signals. Traders will test positions. Liquidity will reassert itself in varying degrees. Supply constraints will remain relevant. Policy clarity will influence flows. Geopolitical uncertainty will continue to support safe haven demand. Taken together, these elements create an environment in which markets adjust rather than reset. The process is already visible in price action. The facts are consistent with measured consolidation. The facts do not point to the resumption of unchecked momentum without new catalysts. For now, the market allows silver space to catch its breath. It allows gold to reconcile gains with economic reality. The structure that drove the opening surge remains part of the landscape. It is not the only element. It does not dictate every move. But it ensures that price behavior will be shaped by physical constraints as much as by paper flows. That balance between paper and physical, between narrative and reality, defines the present state of play. That is the condition the market must now navigate. That is the information that is documented. That is the sequence already unfolding. That is it for this week. Enjoy the weekend, and perhaps give silver a chance to catch its breath. The next phase of this story is procedural. It is technical. It is already unfolding within the same facts the market has produced. Supply and demand remain the central mechanics. The supply story drove much of the advance in silver through the latter half of 2025. Firms altered behavior. Inventories were rebuilt. Stockpiles accumulated. The United States spent nearly a year adding to its holdings because of tariff fears. That accumulation tightened the physical market. It reduced buffers. It increased the sensitivity of price to flows. When one large buyer or a cluster of buyers changes behavior under those conditions, prices amplify. Policy clarity changed a critical input to that process. Late on Wednesday, President Donald Trump announced, following a Section 232 tariff review, that his administration will not impose tariffs on critical metals, for now. That statement removed a proximate threat. It did not erase the inventory that was already amassed. It did not erase the structural questions that had previously tightened supply chains. What it did was change the near-term calculus of purchasers who had been buying with the fear of tariffs foremost in mind. When an acute policy risk recedes, urgency abates. Urgency had been a driver of the recent surge in silver. With that driver diminished, price momentum slowed. Momentum slowed in a measurable way. Gold ended the week below $4,600. Silver slipped below $90 per ounce. Those price levels are not arbitrary. They are the market's response to the new balance of forces. One force softened. Another persisted. The net effect was a moderation in the acceleration that marked the opening 2 weeks of the year. At the same time, macroeconomic signals created separate constraints for gold. Recent data, as reported, point to no immediate need for the Federal Reserve to cut interest rates. The expectation that rates will decline sometime this year remains. However, the likely timing has moved. The first reduction, based on current signals, is not expected before June. That timing matters for gold because interest rate expectations influence opportunity, cost assessments. When the prospect of easing slides into the middle of the year, flow dynamics into non-yielding assets adjust. Higher bond yields and a firmer United States dollar become more relevant. They exert a headwind. That headwind increases the plausibility of short-term selling and consolidation. These are not abstract concepts. They are documented conditions. They are published inputs. They are the forces the market now incorporates. Traders have already responded by stepping away from older heuristics. The traditional precious metals playbook no longer serves as the sole guide. Instead, market participants now operate within a framework defined by tighter physical supply, persistent demand, and shifting macro narratives. Each element is observable. Each element played a role in the dramatic start to the year. Each element continues to influence price behavior. Liquidity, a critical variable, may change as a consequence of the tariff decision. Improved liquidity would make price discovery more efficient. It could reduce short-term volatility. Yet an improvement in liquidity does not nullify supply constraints that were present prior to the policy episode. Those constraints still exist in physical terms. Mines produce what they produce. Inventories sit where they sit. Processing and refining capacity remain finite. Those physical realities operate independently of paper markets, and they will continue to matter should demand reaccelerate. The compressed gold to silver ratio is another documented outcome of the last 12 months. Silver's rally of 150% over the prior year pushed the ratio to its lowest level since 2012. That compression is notable because last year the ratio could not sustain readings above 100. Current market commentary reflects concern that today's ratio may also be unsustainable, at least at elevated valuations without fresh supportive triggers. This observation relies solely on the recorded movements in prices and ratios. It does not introduce new assumptions. It simply notes that when ratios diverge materially from long-term relationships, reversionary forces often emerge within markets. The mechanics of such reversion, however, are not specified in the available data. Geopolitical uncertainty remains a parallel source of support for precious metals. That support is a factual element that has been present throughout recent periods of elevated prices. It offers a countervailing force to the macroeconomic headwinds gold faces from yields and currency strength. The presence of geopolitical risk does not negate other influences. It complements them. It creates a layered demand profile where safe haven motives sit alongside industrial and investment demand. The interaction of these forces shapes realistic trading outcomes. Short-term selling pressure is plausible. Consolidation is plausible. A full and immediate normalization to pre-rally market structure is unlikely given the recorded supply conditions. The market now finds itself in a state where multiple vectors, policy, physical supply, macro data, and geopolitical risk must be reconciled simultaneously. That reconciliation is ongoing. It plays out in price action, in position adjustments, and in the measured pauses that follow rapid advance. Practical implications for market structure are simple and factual. First, supply tension that existed before the tariff uncertainty did not vanish when the tariff threat receded. Second, demand drivers remain active in various forms, including safe, have an interest tied to geopolitical uncertainty. Third, macroeconomic timing, specifically the expected timing of rate reductions, has shifted outwards toward mid-year, creating headwinds for non-yielding assets in the near term. Fourth, liquidity conditions may improve now that one policy overhang has been clarified, but improved liquidity does not equate to the removal of underlying constraints. All of these points are drawn from the same set of documented facts the market has already disclosed. They are not extrapolations. They are not interpretations beyond the available record. They are restatements, organized to reveal how each factual element interlocks with the others. The result is a market that is recalibrating, not collapsing. The result is a market where measured consolidation replaces unchecked momentum. The result is a market where both gold and silver remain relevant, yet face distinct, documented headwinds and supports. As this episode continues, the sequence of events and the public record will remain the governing inputs. The metals began the year with historic gains. Policy clarity on tariffs changed approximate cause of urgency for silver. Economic data shifted the timing for anticipated rate cuts, moderating one of gold's traditional accelerants. Those two factual shifts together altered market tempo. The remainder of the process will be shaped by the same kinds of verifiable moves, policy statements, inventory behavior, macro releases, and geopolitical developments. Each future move will be a reaction to recorded inputs. This is not a dramatization. It is a description of a process that is already underway. It is supported by documented price levels, public statements, and observable inventory behavior. It is governed by the physical realities of supply and the clearly stated expectations for monetary policy. In that environment, the market's immediate task is adjustment. The facts guide that adjustment. The sequence is visible. It continues to unfold. The remaining phase is procedural. It is structural. It is quietly consequential. Paper markets reacted first. Physical flows followed. The distinction matters. Traders operate on paper. Industry operates on metal. Both move price. Both obey different constraints. Paper can shift quickly. Physical cannot. Inventories take time. Supply chains move slowly. Mines produce on schedules. Refineries process on timelines. Stockpiles represent choices made months earlier. Those are documented behaviors. They influence today's pricing mechanics. They do not change overnight. Silver's extreme advance this past year, 150% higher, compressed long-standing relationships. The gold-to-silver ratio is now at its lowest since 2012. Those are recorded outcomes. The compression matters because ratios reflect relative scarcity and relative demand across two distinct markets. When a ratio deviates sharply, it signals stress. That stress resolves through flows. Flows require time. Time is the factor markets now price. Policy clarified one proximate source of stress. The United States had been adding to silver holdings for nearly a year. The accumulation was driven by tariff fears tied to a Section 232 review. Late on Wednesday, President Donald Trump said the administration will not impose tariffs on critical metals for now. That public statement removed the headline risk that had prompted urgent buying. It did not undo prior accumulation. It did not change mine output. It shifted near-term urgency. That shift shows up in price action. Silver eased back under $90 per ounce. Gold settled below $4,600. The market is recognizing a new equilibrium. Not a full return to prior norms. Not a cessation of structural pressures. A recalibration. Momentum slowed. Liquidity may follow. But physical constraints remain. Monetary policy timing is the parallel constraint for gold. Recent data point to no immediate need for the Federal Reserve to cut rates. Markets continue to expect easing later this year, but the first reduction is likely not before June. That timing increases the opportunity cost of holding non-yielding assets in the near term. Higher bond yields and a firmer United States dollar form tangible headwinds. These are measurable inputs that change position sizing and risk appetite. They do not erase safe haven demand entirely. Geopolitical uncertainty continues to support metal prices. It remains a constant, documented factor. Put together, the two changes, tariff clarity and delayed rate cuts, alter market tempo. One reduces urgent physical buying. The other reduces immediate monetary tailwinds. Neither change eliminates the underlying conditions that supported the rally. Supply tightness persists. Demand endures. The market must now reconcile both facts. This reconciliation will be iterative. Price action will oscillate. Periods of consolidation will alternate with new bursts of demand, should fresh catalysts appear. Those catalysts will be visible. They will be policy statements, inventory reports, macro releases, or geopolitical events. Each is a documented input. Each will shift balances in observable ways. For market participants, the practical reality is simple. First, short-term volatility is likely. The rapid advance over the past 12 months created stretched positions. Second, liquidity dynamics may improve as panic buying unwinds, making price discovery less erratic. Third, structural supply constraints do not vanish because one headline risk eases. Mines, refineries, and stockpiles remain the physical anchors that can reimpose pressure if demand accelerates. Analysts weighing the picture tend to favor gold slightly. That view rests on documented movement and ratio compression. Silver's powerful rally has left it in a precarious posture relative to gold. The compression to levels not seen since 2012 raises the prospect that current ratios cannot be sustained without new supportive flows. That observation is not a prediction. It is a restatement of present conditions. The market's new posture also highlights a behavioral change. Traders have abandoned the old playbook. They now operate in a regime defined by simultaneous structural constraints and macro variability. In such a regime, the interplay between narrative and reality becomes central. Narrative moves paper flows. Reality constrains physical flows. Both matter. Neither alone determines outcomes. This is visible in recent trading. The surge that began the year produced record gains in a short window. Those gains were driven partly by positioning tied to tariff fears and partly by broader demand dynamics. The subsequent easing of the tariff threat removed one immediate driver. The delayed timing of rate cuts reduced another. What remains is a market where price must resolve the tension between paper-driven momentum and physical scarcity. Resolution will not be instantaneous. Markets adjust through periods of measured consolidation. They correct through flows that are observable and documented. For silver, the breathing room may allow inventories to rebalance. For gold, the pause may allow macro signals to clarify. Both adjustments are rooted in the facts that have already been stated. End states are not fixed. They depend on further recorded moves, new inventory behavior, fresh policy statements, or shifts in macro data will produce the next phases. Until those inputs arrive, the market's default posture is cautious. That posture is not failure. It is process. It reflects the documented reality that price mechanics require both time and verified inputs to change direction strongly. The immediate takeaway is factual and narrow. The opening rally produced exceptional gains. The administration Section 232 decision removed a headline risk that fueled much of silver's urgency. Macroeconomic data pushed the likely timing of Fed easing out toward mid-year. Those two documented facts changed market tempo. They did not eliminate the structural issues that existed before the rally. They changed short-term incentives. They created space for consolidation. This is not a dramatic verdict. It is a clinical observation. It relies solely on recorded price levels, public statements, and observable inventory behavior. It places weight on physical realities as much as on paper dynamics. It preserves the facts already disclosed. It does not invent new drivers. It describes, in disciplined terms, what the public record shows. As the week closes, positions will be reconsidered. Volatility will moderate. The market will test whether supply constraints can reassert influence in the absence of urgent policy buying. Gold will reconcile gains with the current path of monetary policy. Silver will be given room to pause. The structure that drove the rally remains part of the landscape. It continues to shape price behavior. That is the documented condition. That is the sequence currently unfolding. That is the factual record.